listening to the Fed, you've got Neil Kashkari, you've got Evans, you've got Powell. They're not that worried yet about trade wars. But if we think about the deficits, and then we think about $64 billion worth of paper coming to the market. This is what we put together in GTV in terms of the fiscal position in the United States of America. We're going to get an update now over the next couple of days in the United States. Should I be worried about the $64 billion of issuance, the deficits, or trade? What's driving bonds?
Well, 64 billion isn't too far away from the average over the last 12 months in terms of issuance in 3-year, 10-year, 30 years bonds this week. I guess, but that is missing the point really, because future issuance would be the key. And today what you're going to get is probably the estimate from the Congressional Budget Office as to what sort of deficit are they forecasting for the next couple of years. And the deficit forecast is likely to jump significantly. So the current forecast, which didn't take into account tax reform, didn't take into account the spending bill that was signed recently, project 560 billion deficit this year. The market expects that to be revised to 850. And to that extent, therefore, the question is, which part of the curve would the US Treasury be tapping to finance the deficit? I think the question is whether the US Treasury is continuing to issue more on the front end, meaning 1 month, 3 months, 6 months, 12 months bills, or are they going to basically tap the longer end of the bonds curve? Today, you're not going to get any issuance plan, but you can make inferences, I guess. And you mentioned 64 billion this week in 3-year, 10-year, and 30-year bond issuance. That is higher than what they did in March. Meanwhile, what the Treasury is going to issue this week in 3 months, 1 month, 3 months, and 6 months bills are actually smaller than what they did last month. Yeah. So you can then make the inference that wider fiscal deficit plus issuance in the long end could actually steepen the yield curve, best steepen the yield curve going forward, and that could be dollar positive in my view.
I'm looking at U.S. 10-year yields, and they are at a near record high when compared to the average in terms of the G10 peers. The question that a lot of traders are posing as we speak is more related to the front end of the curve and the potential of a formal inversion of that portion of the curve. How much of a risk is it to you, and how can you mitigate it?
Yeah, well, inversion of the curve tend to suggests that the economy is falling into a recession. So historically, over the last 30 years, when the yield curve invert, then you get a recession or even a crisis in the next 1 or 2 years. And so it becomes important for that effect. But for me, I think the immediate concern, I guess, is less of a recession, simply because there are going to be fiscal stimulus. There are going to be some spending stimulus as well, which to my mind suggests that growth could actually be extended for a bit more. Then the other question would be on inflation and whether the Fed is doing too much or too little. So if the view is that the FOMC is hiking too slowly, then the yield curve could steepen. But if the view is that the FOMC is, erring on the side of caution and hiking too rapidly in curbing inflation, then the curve could invert. I think that's the other thing that you want to watch out for. Now, to that extent, you should watch the March CPI numbers that will be tabled or reported on Wednesday. Now, March CPI is important as well, partly because what we had last year was
can we just chat about that CPI number, because the market expects that to be 2.1% on the core. And this is the debate. Of course, the target is 2%. If you get core CPI breaking through, what does that mean for PCE, which is obviously, the core determinant for the Fed? Are we in a new cycle with potential trade wars, etc., of more accelerated inflation?
Exactly. Trade war would contribute to that as well. And you did mention PCE is the key determinant for the Fed. But the PCE is reported at the end of the month, and CPI is reported 2 weeks ahead of that. And therefore, the market still watches the CPI as an indication of what to expect from the PCE deflator numbers. And they are highly correlated. So if we do get 2.1% in CPI tonight, or even higher, sorry, not tonight, on Wednesday night, and even higher, then you can make inferences towards an expectation of the PCE deflator breaking the 2% mark as well when it is announced later this month, then the question is whether the market would price in 4 hikes from the FOMC. And then you also look at the issuance indicators that I mentioned. So there's a lot of factors that could still affect the bonds market this week, particularly this week in my view. And all the arguments in my view is for higher yields across the entire curve. Whether it will steepen or not depends on how the Fed position itself ahead of the June FOMC meeting.